Hi, in this video we'll be talking about debt funds. Now the debt funds are ideal for conservative investors who are looking to earn that stable kind of a return through interest. It is like giving out loan to someone and earning through interest, and that's why it's called debt fund. So you give out loan to different companies, to government, and you expect return in the form of interest. So it's a fixed income kind of an instrument where you have a predictable kind of a return. You know what kind of a return that you would get because that interest rate is fixed. However, there's another part which is the capital appreciation part, and because of that the interest the net return can go up or down. Let me tell you how it works. So let's take an example here. Right, so let's say you have a company which is paying you 8% kind of a return, and you have loaned a specific sum to it, right? And this loan is given for a duration of 10 years. So every month and every year you'll be getting a stable kind of a return, 8% kind of a return. And as long as the company is doing well, you would keep getting this 8% return. Now what happens is, let's say RBI after 2 years cuts the interest rate, because let's say RBI wants to revive the economy, and it's cutting the interest rate so that people take loan and they spend, and there's some economic activity in the country. So they're cutting interest, and now the interest rate is not 8%, it's 6%, right? Now what happens is, when the interest rate goes down, you would continue to get 8% because that's the contract that you have entered into. However, the present rate is 6%. So if you want to sell this paper that you have, which entitles you 8% return for the next 8 years, now the ongoing interest rate is 6%. So what happens is, you hold something which gives you more interest compared to the present rate. So the value of what you hold would actually go up, right? So I'm sure you must have heard price and interest has the bond price, specifically the bond price and interest rate, they have a negative correlation. What it means is that negative correlation. Now what it means is that in case if the bond price goes up, the interest rate will go down. Rather, the interest rate goes down, so the bond price will go up. So here the interest rate went down, and the bond price, the one that you hold, this is also called bond because it's a kind of a agreement between two parties. So this bond price would actually go up. And why would it go up? Because you hold something which gives you 8% every year, whereas the current interest rate is 6% only. So you can actually sell it midway. You can sell it on the stock exchange, and you can get that capital appreciation. So far you were receiving interest rate, you were receiving interest every year. Now because of the interest rate going down, the bond price actually went up. You can actually sell it. You can sell it to someone else on the stock market and get that capital appreciation, right? Because the bond price has gone up. Now this can also work against you. Now let's say if after 2 years RBI actually decides to increase the interest rate. So interest rate and bond price has negative correlation. So now in case if the interest rate has gone up, the bond price will go down. So there would not be capital appreciation, there will be actually a loss, right? So now what you're looking at is, you have something that's giving you 8% return, but the current rate in the economy is 10%, right? So the value of what you hold would actually go down, because if someone has to look at the scenario right now, if someone has to give out money for loan, they would much rather give it at 10% rather than buy your bond, because your bond would only give 8%, whereas the current rate is 10%. So the value of your bond would actually go down. Now if you want to sell it for any reason, you would have to sell it at a discount. So you would in a way incur losses here. So that is the kind of interest rate risk that you have. So one is the credit risk and the other is interest rate risk. This is associated with the debt funds, right? So I'm just trying to make it as simple as I can be, so that because this is something that you need not really know as well, but if you know it, it's better, because if the interest rate is expected to go down, then it's much better to invest into short-term fund. However, in case if the interest rate is expected to go up, RBI keeps deciding whether the interest rate should go down or up. In case if the interest rate are expected to go up, it's much better to invest into really short-term fund or liquid fund, because if the interest rate goes up, this bond price will actually go down. So you may incur some loss. It would be a temporary loss, because let's say this company is still existing and everything is working fine. So you would, for a brief period, you would see the bond price would actually come down. But after 10 years, what would happen is it would have given you 8% year on year, and after 10 years it would give your principal back, right? So if you have the capacity to hold on, and if you do not need this money, this capital appreciation, the bond price will go up or down, but at the maturity, the bond price would be equal to the issue value, the par value. So whatever principal that you had given as loan would be returned to you after 10 years, assuming that there was no credit risk and the company was doing business and everything was fine, and it gives your money back. So after 10 years, you would get your principal back, and all these 10 years you have enjoyed 8% return, right? So if your investment horizon matches with the tenure of the loan, then you need not worry. There is nothing to worry as long as there is no credit risk, right? But if you're looking to gain that capital appreciation and you expect the interest rate to go down, then you can invest into a short-term fund or even a long-term fund and enjoy the benefit. And the best is you can let the fund manager decide whether he wants to invest into a short-term fund or a long-term fund. You can simply invest your money. Preferably it should be a short-term fund, right? We'll get to what kind of funds that are available for debt funds. So we'll look at that. So we have these kind of funds available. We'll look at them in our next video.